First, let us get clear on what each product is designed to do. Term life is protection for a specific period. You pay a relatively small premium, you get a large death benefit, and the insured takes the risk that you might die during that term. If you do, the policy pays the death benefit. If you do not, the policy expires and you have no cash value. Whole life is permanent insurance. You pay a higher premium. Part of that premium covers the insurance cost and expenses, and part is allocated to cash value. The policy is designed to last for life, and the death benefit is intended to be paid at some point, assuming the policy stays in force. Now let us define the metric we will use. 30-year total cost equals all premiums you paid over 30 years, minus the cash value you could reasonably access at year 30. That last phrase matters. Cash value is not the same as money in your checking account. Access can come through surrender, which ends the policy, or through policy loans, which create loan interest and can reach the net amount delivered to your beneficiaries if not managed. So when we say cash value you can actually use, we mean net cash value that can be taken out after policy charges and typical access mechanics, not the glossy number on an illustration that assumes you never touch it. With that in place, let us go through the typical 30-year experience. For term life, the math is simple. Total cost is basically total premiums because there is no cash value. But the benefit is also simple. You can often buy a very large death benefit for a relatively small cost. That is why term is widely used for income replacement, mortgage protection, and child-raising years. For whole life, the math is more complex. Total premiums are much higher. Cash value typically grows slowly in the early years because of front-loaded costs. Over time it may accelerate, especially after surrender. Charges fade and the cash value base becomes larger. By year 30, a well-designed policy may show substantial cash value. But whether that makes whole life a winner depends on the relationship between premiums and accessible cash value, plus the value of permanent coverage and guarantees. Now, before we talk about winners, we have to define what winning means. If your only goal is the cheapest death benefit for the next 30 years, term wins almost every time. If your goal includes permanent coverage, stability, and guaranteed outcomes, the comparison changes because you are not buying the same thing. This is why people talk past each other. They are using different definitions of success. So we will evaluate winning in 3 practical ways. 1. Protection efficiency, meaning how much death benefit you can buy per dollar today. 2. Net 30-year cost, meaning premiums minus usable cash value. 3. Outcome certainty, meaning how predictable the long-term results are. Let us start with protection efficiency. Term almost always wins here. If you are 35 and healthy, a 30-year term policy can provide very large coverage for a modest premium. Whole life for the same death benefit often costs many times more because it is permanent and includes a cash value component. So if you need $1 million of coverage to protect a spouse and kids, term is usually the only way to get that amount without crushing your monthly budget. Now net 30-year cost. This is where the story becomes interesting. Term cost is the premiums, period. Whole life net cost is premiums minus cash value. If the cash value at year 30 is large relative to premiums paid, the net cost can be closer than you would expect. But if the policy is surrendered early or designed poorly, the net cost can be far worse than expected. Here is a simple conceptual example, not a quote or a guarantee. Imagine term premiums total 45,000 over 30 years. At year 30, your cash value is zero. Your 30-year total cost is 45,000. Now imagine whole life premiums total 240,000 over 30 years. At year 30, your accessible cash value is 108,000. Your 30-year total cost is 60,000. In that specific scenario, whole life looks surprisingly close, and that is the point of using the right metric. But now change one variable. If accessible cash value is 120,000 instead, the net cost becomes 120,000, and term clearly wins on cost. So what controls those outcomes? Policy design, internal costs, dividend performance, if applicable, how long you keep it, and whether you take loans. Also, whether you compare against a realistic alternative, investing the premium difference. That is the biggest missing piece. When people compare term and whole life, they often forget that term frees up cash flow. The correct comparison is not term versus whole life in isolation. It is term plus investing the difference versus whole life. If you pay $800 more per month for whole life, the alternative is paying that $800 into an investment account consistently for 30 years. If you do that with discipline, the investment account may exceed the whole life cash value in many cases, and the money is typically more liquid. But investments are not guaranteed, and the market can be volatile, especially over shorter periods. This is where outcome certainty comes in. Whole life tends to offer more predictability. Cash value growth is usually steadier, and the policy has contractual guarantees. Term plus investing the difference can produce higher expected returns, but the range of outcomes is wider because markets move. Now, let us answer the headline question directly. When term actually wins? Term wins when your need is temporary. If you need coverage until the kids are grown, until the mortgage is paid down, until you reach financial independence, term is engineered for that. Term wins when budget matters. If whole life premiums would force you to undersave elsewhere, skip emergency funds, or take on debt, term is usually the better decision. Term wins when you are comfortable investing, and you will actually invest the savings. Consistency is the key. A small monthly difference invested for 30 years can become a substantial asset. Term wins when you want flexibility. You can change coverage later. You can stop paying without